RRSPs are interesting because a lot of people have RRSPs and they're using them to invest in stocks and bonds and other facilities. However, they don't know that they can use it to purchase a home. So if you're a first-time home buyer, which means that you've never owned a home before, or by some definitions, according to the CRA, if you haven't owned a home in the last 5 years, you're a first-time home buyer, meaning you can withdraw money from your RSPs and use it towards the purchase of a home. Now, normally when you say withdrawing funds from RRSP, it means there's gonna be some taxation involved. So if you withdraw $50,000 from your RSP, that adds to your income for the year, and now that becomes taxable. However, when you're using the home buyer's plan, you can withdraw up to $35,000 toward the purchase of a home, and then you get to pay it back in installments over a 20-year period. So this is a great avenue to take if you've been dutifully saving money in your RSP and now you need to use it to purchase a home for yourself to live in as your primary residence. So that's one way you can use the RRSP to be able to purchase a home and use it for a home buyer's plan, which a lot of people are unaware of, or which we're trying to bring to your attention. Now, the way the RRSP is calculated, people are unaware, but the RRSP is calculated based on the income that you've made. You can put up to 18% of your income into the RRSP for any given year. So if you made $100,000, you could put $18,000 in. Now, the maximum contribution for any year, and it escalates year over year, is for this year is $27,000. So the maximum amount of RSP contribution you can make for 2020 is $27,000. So if you're making in the $150,000 range, you can put in your full 18%. This reduces your taxable income, which is good, and you can invest it, like I said, into first-time home buyers. Now you can withdraw it. So that's a very creative cycle. So what I advise people to do many times is, if they're gonna purchase a property and they haven't purchased one before, instead of just taking the funds and buying the property, they may have an accrued RRSP limit. Maybe they have never put money in a RSP before, and the RSP limit accrues every year. So if you've had 5 years and you made $100,000 and you could have put in $18,000 a year, and you didn't put in the $18,000 in any year, now you're gonna have that full amount that you can put in at one time, or more than 18,000. Maybe you can put a chunk of 30,000. Maybe your down payment is 30,000. So let's do an example. You have a $100,000 RSP limit, and you want to put down 35,000. Now you have 35,000 sitting in an account. Why not take the 35,000, put it in your RSP first so you can get a deduction, then use your home buyer's plan to remove the money, and use those funds now to invest in your property. What this does is creates a dual effect. You have made contributions to your RSP, so you have that. You've reduced your taxable income for that year, and you've still been able to buy a property. Now you're going to get a tax return when tax time comes, because your income went from 100 grand down to 70 grand for the year, even though you've been taxed at source as if you were making 100,000. So now you may get $10,000 or $12,000 tax return, depending on where your taxes were and what other write-offs you have. Now you can actually take that 12,000 and invest it in something else. So we've created a whole multiple income stream off the one RSP. So let's run it back. Let's take the money and put it in the RSP, take it out, use it for the home buyer's plan, and then take the tax return and use it for further investment. So these are some creative ways in which to use the RSP. I think it is a good vehicle that the government gives us. What I don't want people to do is take the RSP and use it to buy stocks and bonds or things of that nature. These are things that you absolutely have no control over. They say gambling is putting money into something with an uncertain return. And what is that if not stocks? It's an uncertain return. You have no control over the company. You don't know what their management structure is. You've never sat in a board meeting, but you're gonna give them money. So the RSPs to me are to be used for your own personal investments instead of giving the funds to somebody else and letting them invest on your behalf. Now, this strategy that I've created is a good way to create income and to put yourself in a situation to win. Now, another thing that you can do with the RRSPs is you can do an arm's length mortgage. What an arm's length mortgage means is you can lend out money from your RSP. Now, it's still in your RSP. Remember, RRSP is a vehicle, right, to use to invest. A lot of times when I mention using your RSP to do an arm's length mortgage, which is lending someone funds to invest in a second mortgage on their behalf, people say, well, is that going to be a withdrawal? That is not a withdrawal. Putting money into a second mortgage or lending money out from your RSPs is not a withdrawal. It's the same as using those monies to purchase Apple stock or using the monies to purchase some type of mutual funds. It's the exact same thing. Only difference is you actually know where your money is going. It's being registered on something tangible. So the arm's length mortgage, they have different companies that will allow you to do this. So you can take your RSPs from whatever financial institution they're in. I like to use Olympia Trust, but there are other financial institutions out there. You take the funds from RBC, for instance, you put them in Olympia Trust. Now you have a client who comes to you or a person who is arm's length. So it's not a family member, it's not a friend. It's someone you don't know on a personal level, but you have a relationship with normally through a mortgage broker. They call you and say, Mr. or Mrs. So-and-so, this person needs a second mortgage for $20,000. Now you have $20,000 in your RSP. Now you're gonna be able to take that $20,000 and lend it to them at a fixed rate of return. The key is it's a fixed rate. Let's say for instance it's 10%. Well, you know that you're gonna make $2,000, then that is a real return, that it's a tangible return. Not only that, it's registered on a property, so therefore you're not concerned about the market going up and down or things of that nature. You know you're gonna get this return. On top of that, in terms of default rate, we know the default rate in Canada is very low, and at the present time, people who have good credit and have income are still taking second mortgages because the restrictions have been so tight on lending money from the banks and from the government, especially for self-employed individuals. So a lot of times people are in a great position. They really should be able to have access to funds, but because of the way the financial system is being adjudicated, they don't have access to the funds right now. Now, whenever I'm going to advise someone to get into these second mortgages through the RSP, I say you should go through a reputable channel. I use Sherwood Mortgage Group. They're a very reputable institution. They've handled a lot of my second mortgage needs. They have a lot of good clients. But the good thing is it comes directly to you. So the file goes on your desk. You can review it with your mortgage broker or agent or whoever is giving you the information. You can get their where they work, their employment, their credit score, all the information that is afforded to a bank. You get to become the bank. All that information that is normally afforded to the bank, you have access to that. Now, the most important thing when we're dealing with lending money out through RSPs, because these are retirement savings, so we do want to be careful with them. The most important thing is how much the property is leveraged and where it's located. So I do my lending on my second mortgages in the GTA. Not to say properties outside of the GTA are not fit for it, but I like to make sure in the event, if a catastrophic event happens and we need to liquidate the property for whatever reason, even though this is a very rare occurrence, we can see from current events that you should always be prepared for a rainy day. So if I need to liquidate the property, I want to make sure it's somewhere that can be easily liquidated, which I prefer the GTA. And then I'm only gonna go to maximum 80 to 85% loan to value. And the loan to value is how much the property is worth based how much or against how much of the loan is currently on the property. So for instance, if the property is worth $500,000, 80% loan to value would be 400,000. So I wouldn't lend them $20,000 if they owed $450,000. Too much exposure in terms of my funds. Now, when they're only at 80 or 85% loan to value, the default rate is very nominal. So you have to look at all the considerations, all the factors, but I want each of you to be a steward of your own money instead of letting someone else control your own money, and then when you don't get the outcome you're looking for, you're in an unfortunate situation. For me personally, maybe I haven't, every decision hasn't led to a win, but if I haven't won, I've learned from it. But I can't learn a lesson vicariously through someone else who has my money and I have no clue what they've done or how they've actually managed the money. It's very difficult to learn. The only lesson you can learn from that is don't let other people take your money, invest it on your behalf, and you not really being aware of everything that's going on. So when we're talking about the RSPs, I think it's a great way to put yourself in a position to buy a primary residence for yourself, B, to lend out money in an arm's length fashion to other people in the marketplace who are credit-worthy individuals who are looking for funds to do renovations or other ancillary activities that we deem to be responsible.